How you doing? Or good afternoon. It's actually 11:59. Uh, for those of you on the West Coast, will still be good morning. We do have quite a few of our team that is on the West and other than Eastern Standard Time. Thank you for joining us for today's training. Really good training today on analyzing self-employed borrower income when the borrower is deriving their income from an S corporation. Okay, this is an additional segment. Last week we did the sole proprietor. Today we're doing S corporation. Next week we will be doing the very tricky C corporation. Make sure you tune into that one. So, S corp, pass through entity, right? That's what we're talking about. Could be one individual, could be a number of stockholders in the S corp. So let's get right into it. So, an S corporation is a legal entity with a limited number of stockholders. Now, real important to note here in these key points is stockholders are not personally liable for the debts incurred by the corporation. Um, a corporation has articles of incorporation that are filed with the Secretary of State for the state where the entity was formed. Please note that other documents that you would need when you have an S corporation borrower are the EIN letter that they receive from the IRS, an operating agreement, which will document their percentage of ownership if you're not going full doc. I mean, if you're going full doc, it's going to be on the K1, right? Uh, and then you have the EIN letter, or see, that's we already covered that, and the operating agreement. Yeah, yeah, and the corporate resolution actually is what I meant to say, which at the end is a document that gives them the authorization to transact business for the corporation. If, for example, they're taking title in a corporate entity, for example. So an S corp is a pass-through entity. Real important point here, where the profit and loss is passed to the individual stockholders according to their percentage of ownership. So I was mentioning the Schedule K1. That is the document that is used to pass either the income or loss to the stockholder according to their proportionate share. So if they're 100% owner of the S corp, of the stocks in the S corp, then it's going to show 100% on the K1. If they're 33% owner, it's going to show 33%. Keep in mind that in order to be considered self-employed, the individual has to have at least a 25% or greater ownership interest in the S corp. Less than 25%, they're not considered self-employed. So that's a key component because sometimes, as part of quality control, when they're doing the background search, the individual, also known as fraud guard, uh, the S corp or LLC may come up linked to the borrower, and then you have to provide documentation to show that they're not an owner, that they're not considered self-employed. Would be normally, if it's a full doc deal, you're going to provide a K1. If it's not a full doc deal, you'll probably maybe provide an operating agreement or something to the effect, a letter from the tax preparer as well. Um, so that means that the corporation doesn't pay any of the taxes. The taxes on the income are paid for by the borrower, by the stockholder, via the 1040. Uh, Please also note now that a borrower may receive W 2 wages from his or her S Corp as a supposed quote unquote employee, right? But they're not really an employee of their own corporation. They just are receiving W 2 income, and that because that's the way that they are drawing part of the money from the company, right? They're drawing part of their earnings from the company via W-2. So they could have some payroll taxes and all that kind of good stuff that's associated with that. Um, we're talking about Medicare tax, income tax, stuff that I guess would go towards your retirement, and also their tax strategy, depending on what their accountant has advised. Some may just take it all as retained earnings, and then you see it in their 1099 Schedule C, possibly, or just straight up in the 1040. But the important thing to note here is that if they do receive W-2 wages from their S corporation, of which they are at least 25% or more owner of the stock of the S corp, then they are considered self-employed. They are not an employee, and you have to follow whatever documentation requirements you need for a self-employed borrower, and not for a W-2 employee. This has created confusion in the past, because we have a borrower turns in pay stubs, turns in a W-2. It's a full doc deal. Agency loan gets run through automated underwriting. Let's say we're doing conventional. We get a 1 year findings for on AUS, just asking for 1 year W-2s, 30 days worth of pay stubs, right? Because we have a salaried or salaried individual. But then fraud guard comes back, or somebody reviews the W-2s or does a check on the company, whatever may happen, that all of a sudden we find out, hey, wait a minute, he's an owner of the company. So now the deal has to get restructured. We run it through automated underwriting. Now all of a sudden we don't get the 1 year findings. We have the 2 year findings. The business has only been in business for 3 years, so we can't go LP for the automatic. If you've been in business 5 years or greater, only use 1 year. DU gives it to you if they like the deal, right? If the risk factor is adequate, they're only going to ask for 1 year. DU doesn't have a 5 year rule. I'm not talking about DU, we're talking Fannie Mae, LP, Freddie Mac. So in that scenario, now all of a sudden our loan totally changes, because now we have to provide 2 years tax returns, and wouldn't you know it, the 2022 tax return was abysmal, right? Didn't do that well, and now we have to average that really low 2022 with a 2023, and now our income is shot, right? So just be aware when they are W-2 wages and all that kind of stuff. You may want to ask if you see that it's not like a big company or anything like that. So for the self-employed borrower, right, that borrower that we've determined that's 25% or greater ownership interest in the S corp, the standard is for a 2 year history of self-employment requirement in order to be able to consider the self-employment income, right? That's like the standard threshold. However, like with a lot of things in this business, there are some exceptions, I guess some gray areas that we would call them, where you are able to use the income if they have less than 2 years full self-employment. One of the exceptions would be if the borrower is receiving same or greater income in a similar field or position, right? And the second would be, these are very similar, but it's just a little difference in the wording, where one talks about income doing similar field or position, and the other one talks about borrower in a similar occupation in which they had similar responsibilities. So what would be some real world examples for this, right? And by the way, this is going to be applicable for full doc type loans going agency, or for example bank statement loans, right? It's the same concept. You just have to review guidelines, right? This is a generalization of what the guidelines state in agency loans, and then obviously non-QM, all the guidelines are going to be different. Some allow for this exception, some don't. So real life examples here would be you have a nurse, right? A nurse has typically has a nursing license, some type of certification. This nurse is working as an employee for a doctor. Now the nurse decides to go 1099, right? She formed, maybe she formed an LLC or not, but let's say she's going 1099. She's getting 1099 income. Now she's self employed. She's still a nurse. She still has that nursing license. For the nurse, it's and anybody else that has a license, it's going to be a lot easier because you're linking the experience to the license. Very easily verifiable component, right? Electrician's license, nursing license, doctors, right? Uh, attorney, right? Was working for a firm. Now they have their own firm. So the key component there is going to be either reading the findings, if it's an agency loan, from your automated underwriting submission, or reading the guidelines and seeing what they allow. Typically, in the findings that you're going to get in the agency loan, is that the borrower, you're going to need to provide at least 12 months worth of income for that income stream in the last tax return, right? So, in other words, if 2023, for example, they were doing it from January 1st until December 31st because they actually started doing that type of job in December 15th, going self employment, then you would have 1 year's 12 months, actually, is what they require, worth of income on that tax return. You're probably going to be good. They're going to average it out, maybe with the W 2 income that they had or not, depending which is the bullet point that you're using to try to get the exception. If you're going with the similar or same or greater income in a similar field of position, they're probably going to average it out. If not, you're looking at the licensing. Uh, and obviously, you're going to push the averaging out if there was good income, right, from the W 2. If not, you're going to go with the, hey, let's just use their self employment income now, and then let's hope that it's really good. So, you're seeing how you can get the exception to less than 2 years in business, and it's really going to be linked to what were they doing previously. If they were a similar type of involvement, then there's a very good chance that you're going to get the exception. Now, for in terms of the income stream, right now, this is very important that you follow the paper trail here because this is where many MLOs make the mistake when they're calculating, they're analyzing and calculating what they need. We get the borrower self-employed, all they're giving us is a 1040. They don't know they got to necessarily give us the 1120S, and maybe the MLO didn't ask for the 1120S if they have an S-Corp. But or maybe they are saying, now this is how you can also see that the W-2 borrower who says that he's an employee is really an owner, right? This is where your detective work comes into play when you're analyzing the documentation. Because first and foremost, the business income, in other words, the profit and loss breakdown of that business, of that S Corp, is going to be reported on IRS Form 1120S, as in Sam. That's an S Corp tax return. Every S Corp needs to file one. By the way, sometimes you're going to see people that have an LLC file an 1120S. They have the LLC for liability reasons, and then they're filing as a single member LLC in an S Corp to be able to file their documentation, because the 1065, and this is for another lesson, but the 1065 is for partnerships. So you have an LLC, single member LLC, and you're going to file a tax return, you're probably going to have to set up a S Corp and file an 1120S as well. So now note the 1120S breakdown of all the expenses on page 1, right? Page 1 has the gross sales or revenue, has all of the expense components. The main expense components are listed there, and then you get reference to other statements or pages on that. So that's where you're going to see all of the breakdown. So when you're doing your self-employment borrower income calculations, of an S-Corp borrower, you need to have the S-Corp tax return, because that's where you're going to draw items such as depreciation, amortization, depletion, and all those other items like that you, plus the income, the main income of the corporate side. Because on the worksheet, you're going to have that section, plus you're going to have the K1 section where you're going to document then where each partner's share, each partner's proportionate share of their income. So if you have three stockholders in that S corp, they're 33.3333% owner each one. So each partner's share is going to be reported on the K1, right? And that's going to say 33.33% owner, is going to list the income, the ordinary income on line 1. Then you're going to have distributions, usually on line 16D as in dog. That's very important, because in a corporation, the only income that you are really going to count is the income that is distributed on 16D, unless the business has liquidity, right? Assets greater than liabilities. Then you can use the stated income on line 1, even though they may not have distributed any of that income on box 16D. That's what the distributions are, when they actually physically take the money out of the business and into their possession on a personal basis, right? So you'll note that it goes from the 1120S. The income is then reported to each partner on the K1, and then that amount reported on the K1, which has the tax ID number of the S corp, is reported on the IRS personal tax return 1040, Schedule E as in Edward, page 2. Now, most people know the Schedule E as the schedule for real estate, right? Where you have real estate income and expenses for each of your properties. I think it's like 3 properties you can put per page on a Schedule E. So you need more than 1 page if you have more than 3 properties. And then the final page of the Schedule E, in this case, if you have more than 1 Schedule E, it wouldn't be page 2. It'd be the final page of the Schedule E, would be the page that shows any money's coming, any royalties coming from corporations, partnerships, or other types of entities like that. You're going to see it on there. You're going to see passive income, non-passive income, passive loss, non-passive loss. You're going to see a tax ID number. You're going to see the name of the entity. And if you see that there, then obviously that's when you're going to be alerted to that. They may not have provided you a K1. Then obviously you're going to ask them for a K1 at that point. And then you're going to confirm their percentage of ownership. And then you're going to ask them for the tax returns, the 1120S of the business, so that you can properly do your income calculations, where then you're going to put on the schedule a self-employed borrower income calculator. Is going to have the first line is going to be for W-2 income. That's W-2 income from self-employment, not W-2 income from a real job they may have outside of the W-2 income from their self-employment. That some people do have multiple income streams like that. That would be W-2 income from their self-employment. And if you got Schedule B, C, or D, or any kind of additional income like that, that's from self-employment, would be on there, not the one that shows on their regular 1040 from their regular business activities of like dividends and interest and all that. That is not for that, for the self-employed borrower income calculations. So then you'll have the section there for the 1120S section. You'll have the section for the K1, right? On the 1120S section, that's where you're going to capture the expenses that you're going to write off. But that's on the next page here. So then, just so you know, then from Schedule E, page 2, or depending what page, the last page of the Schedule E, that income then is combined. If it's 2 or 3 or 4 entities on that Schedule E, that income is then combined into Schedule 1. Notice all these additional schedules. And when the borrower only sends you page 1 and 2 of the tax return, they're doing you a disservice here. So that income then, self-employment income, goes to Schedule 1. And then, combined income, losses, whatever, all combined into one number in Schedule 1. And then that number from Schedule 1 is transferred to page 1, line 8 of the 1040. So it's really important that you follow this paper trail so you'll know what documents you are missing in order to properly calculate the income of your borrower. And also to note that if you see a 1040 with a Schedule E, page 2, and there's a corporate entity on there, now you got to start asking for additional documentation because there's a good possibility that your borrower owns at least 25% of something or more and is actually self-employed. So I was touching base on the 1120S income and expenses, right? And basically, I want to share right here our key concepts for that because that's another component when you're completing the income and expense worksheet that you need to know what numbers to put in there and what numbers not to put in there because the worksheet just tells you grab the number from line number 31, grab the number from line number 21, from line number 1 of the K1, but it doesn't, you got to know why you're grabbing it and if you're able to actually use that number. And it boils down to a couple of categories here. The first one is non-cash expenses. These are expenses that can be added back to the income. So when you're doing the 1120S section of the self-employed borrower income calculator, these categories are the ones that typically can be added back really easily. So the first category is depreciation. It could be either real estate or a chattel asset like furniture or equipment. Mind you, it could be on page 1 of the 1120S, or it could be also on form 8825, I believe, which is the depreciation form. If they don't have it on any depreciation on the first page, look through the whole tax return and see. You may see it in another schedule. That's a great one to add back. Now, depletion, rarely do we find it, but depletion is when a business uses a natural resource like oil. So depletion is the exhaustion of a natural resource that they need for their business operation. And the logic here is to allow them to recoup, have less, have credits towards their income so that they can save money to be able to purchase these natural resources again to continue their business operation. And then a really tricky one is amortization. Now, amortization is not what you typically consider, right? Amortization, when MLO normally hears it, they're thinking the amortization of a loan, right? The principal balance, the paying down of the balance of a loan, right? The amortization. But that's not what we're talking about here. Amortization would be one-time business startup expenses like patents, surveys, building up goodwill, a lot of things like that before the business even begins operating that you need to invest in. And typically, the word that needs to appear in the expense category is amortization. Now, you may be able to get away with it if it specifically says one-time business startup expenses or something like that, or business startup expenses, and it lists them out. Then you can tell the underwriter, hey, listen, what they really meant here was amortization. So then you can recapture that expense and add it back to the business, to the income, right? Because it's one-time business startup expenses that is never going to occur again with that business once the business is up and running. That's why it's considered a non-cash expense. Second category here is expenses limited by the IRS. Now, this category, any expenses in this category are reduced from the income, right? It's a subtraction, not an addition. The logic here is that typically these expenses that are limited by the IRS, that means that the IRS does not allow you to recoup or to charge off 100% of that expense. So the logic is that the percentage that you are not allowed to write off is the amount that has to be deducted from the income. So The most popular category for this is meals. Meals and entertainment, I believe, is how they call it in the tax form. IRS only allows you to deduct 50% of this amount. So the other 50% is reduced from the income. That's how that one works. And I've seen these pretty high amounts, 7, 8, 9, 10, 11, $12,000 in some tax returns, depending on the type of business that they're in, where they may be taking a lot of people out to lunch and dinners and stuff like that. And the last category here in these very important key concepts, this is a super important one, saved more than one deal for me, is the relationship between recurring and non-recurring income or loss, right? So first, what do we mean by recurring? Recurring means that item, whether it's an expense stream or income stream, is expected to continue for at least the next 3 years. Remember that 3-year rule uh, that we have. And then non-recurring means that it's a one-time event that cannot be considered towards income or expenses. So, what are some real world examples here of these? And really, it's more of the non recurring ones are the ones that we really need to consider, because we're going to have non recurring income, but especially we're going to have non recurring losses. That's really the one that is going to allow us to save the deal, because that loss is reduced from gross revenue, and it affects your bottom line. So if you can get that loss added back, you could in some cases significantly increase your net income. So the non-recurring type examples would be sale of an asset where the business is not in that type of business, right? So let's say you have a business that sells two of their trucks, right? Some nice fancy type vehicles, and they get $140,000 for this specialized equipment because they're buying the latest generation one, but they're actually in, let's say, agriculture, right? They're not in the business of selling heavy equipment. So that $140,000 of income would not be able to be used towards income. So that one hopefully is pretty obvious. Now, the one that could be a little trickier is when you're trying to get that loss removed and get it added back. Now, a real common, two of the most common areas of this would be a casualty loss, right? Like a theft, fire, hurricane, which caused a loss of business, and they had to put in a claim or something like that, and then or they had they didn't, there was a big deductible of $50,000 on the policy before it kicked in, so they wrote off that $50,000 as a loss, right? But that's a casualty loss, so that can be added back as long as they provide documentation from the claim and what they paid out and what they didn't pay out and all that kind of very easily obtainable documentation. And the other very common non-recurring loss would be a paper loss that has been carried forward. So a carry forward loss where maybe 3 years ago they had a big loss in some kind of category that then they are allowed to carry that loss forward for the next maybe 5 years or the next 10 years, whatever it may be. Then that one would require documentation from the accountant to clearly explain the accounting rule that was used and the type of, what actually was the original loss, and that it's a carry forward paper loss. And then you should be able to get that loss added back to the income, right? In some cases, these carry forward paper losses can be a very significant amount. So really important here, these key concepts. This is where I also see if you got all your documentation and you've overcome that hurdle where you have your 1120S and your 1040, then the other obstacle is actually knowing what you're reading. And last but not least, do know that you are, depending on what time of the year the loan is occurring, if the loan is occurring in the first quarter of the year and the tax returns presented are very recent, right? Like it's March 10th, and the tax returns are from 2024, and it's March 10 of 2025, then you're good with just the tax returns. However, once you exceed the first quarter of the year and the tax returns are from prior, now if they were, then you're going to have to provide a P&L. Even if you get the tax returns now on, let's say, June 10th, dated June 10th, it's not the day they date the tax return, because that tax return is for the business activity of 2024, right? So you would still have to provide, or the borrower would have to provide, a signed profit and loss statement for the business, the year-to-date business activity from January 1st through June 10th, or let's say May 31st, if we were doing a June 10th loan, to document the income of the company to make sure that it is continuing the same. Please note that they're not going to let you add income from a real juicy looking profit and loss, but they will certainly deduct income if the profit and loss shows a lower income than whatever you were showing as the monthly income, depending on if you had a 1 year or 2 year findings, whatever you were doing, and your income was calculated, and now you're at $6,000, and now the P&L that you've turned in or the borrower provided shows $3,000 per month. Now you got a big problem. Now you have seriously declining income, and we're going to have to get explanations from the borrower, from the accountant, as to, is this just timing? Do most of the contracts come in later in the year? Are we in the slow season? What's going on that the P&L is showing such a reduced income? So keep in mind how P&Ls are to be used. So I'm going to give it a moment to see if we have any questions. This is a very, very important training today on S-Corp. So we have the main points here of guidance to properly analyzing that income, knowing what documentation to ask for, so that you can not have any obstacles. Okay, so hopefully it was very clear to everybody, because we do not have any questions. So thank you for joining us for today's training. We do look forward to seeing you next Tuesday. And remember, next week we are going to be analyzing the very tricky C-Corp. Everybody have a great day. Oh, wait, we got a quick last minute question here. Any way to work around adding back health insurance tax credit if required to pay it back? Wow, that's a tricky one. Any way to work around adding back insurance tax credit? I'm not sure if I understand the question. I think the question is, if you're required to pay it back if you add it back. I'm not really sure if I understand the question. That's not one of the normal categories of expenses that we are able to add back to income. Seems like that's one where we would be looking for an exception, because they're required to pay it back anyhow. So we're looking to see if we can add it back. I'm not really sure, but I've never encountered that one. I'd be interested in getting some more information on it from the MLO that posed the question. So do look forward to seeing you all next week, and have a great holiday weekend.